Hello and welcome everybody, both new and returning. If this is your first time here, welcome to Sectors Made Simple. My name is Jonathan Stav, and every Friday on this YouTube channel, we like to go through different parts of the stock market and talk about either general investment knowledge, topics that you might find interesting, or, as the name might suggest, we talk about market sectors and how we can invest using market sectors and sector rotation strategies. So, if you are returning, welcome back. Thank you so much for being here. It's always a pleasure to see you. Now, I have a very fun webinar scheduled for us all today. There's been a lot that's happened in the past only 2 weeks in the market. We've seen some statements by Jerome Powell that has sent the market into a tailspin, and it leaves us asking, what's next? Well, today, I want to take a look and try and answer some of that. While it's impossible to say we know exactly what's coming next, instead today what we'll do is look at various different indicators and probabilities that we have available to us to try and understand what might happen next, as well as I have a few dates for you to mark down on your calendar so that you don't miss out on any of the important announcements that will be coming through for us in September. So if that sounds good, you're in the right place. If you can, just give the video a thumbs up. It helps me feel good about doing webinars like this. It helps the algorithm, and everyone's all happy. So, I'm not going to hold this off any longer. Let's get straight into today's presentation and the data. So, today is going to be all about the September 2022 market forecast. Sorry, just reading some comments. Hi, Jonathan. Thank you so much for your email and for talking about 3M. It was very helpful. Oh, I'm so glad. Yeah, it was very interesting to see what was happening with 3M. And while unfortunately I was on vacation for the week leading up to it, it was very nice to be able to talk last week about what that 3M split off and subsequent merger means for investors and what that kind of stock exchange really meant for us. But let's get into today's stuff with the market forecast. Before we do, I'm saying the word forecast once or twice. Just like a weatherman can give a forecast and say that it's sunny tomorrow and a hurricane forms out of nowhere and causes massive storms. A forecast is just that, a forecast. We're using past data and current atmosphere to try and understand what might happen in the future. This is very much me collecting data, trying to give us as well of a well-rounded position and understanding as I can, but it is all using historical data, present trends to try and predict future behavior. With any sort of predictions, they're not going to be perfect, and these should not be taken as financial advice. This is strictly supposed to be educational and insightful. So please enjoy the content for today, and always, prior to making any investment decisions, do your own research as well. So let's talk about what the goals for today's webinar are. Well, quarter three was interesting, and I guess we're still in quarter three, but quarter three has been extremely eventful for the market. We're moving now into the final month for quarter three, and the market sits in a very, very precarious and kind of on a knife's edge kind of position. Jerome Powell, the chairman of the Fomc and the Fed, at their economic symposium in mid-August, spoke and was a little aggressive in tone about how he views the state of the economy and the actions that the Fed plans to take to continue combating inflation. As a result of that speech, the majority of sectors dropped in value, major indices, of course, following, and this left many investors to wonder, what's next? If we thought we knew we were working towards recovery and the past 2 weeks have shaken that up, where are we today? So this question, I will tell you right now, if you're looking for some magic 8-ball answer unclear. I actually haven't used a magic 8-ball in a while. I don't know what it says, but my magic 8-ball, I bounce it around a little bit, says answer unclear. Because it's impossible for us to know what's going to happen next. But today, I'll do my best to share some data that I've found insightful with you all and analyze that data to see what it can tell us about what we could expect to see in September. Now, before we get into September, that is forecasting, but instead I want to do a little bit of reporting first. I want to talk about where we are and what's led up to where we are today. So to do that, let's start off by looking back at August. Up until mid-August, and by that I quite literally mean the Friday of his speech on August 19th, we saw a period of significant growth in the stock market. To show a couple of major indices and their percent changes from their low point back in June to their high point that we saw in August, the S&P 500 was up 17.5%, nearing that bull market line again of 20% above its low. The NASDAQ was up 23.3%, entering into a new bull market, and the Dow was up 14.3%. Now, all of that changed on Friday, August 19th, as Jerome Powell at an economic symposium spoke about the current state of the economy and what the Fed is doing to try and direct it into the correct path that they want it to be in. And in that statement, he said that the Fed will continue to aggressively fight the current rate of inflation. Now, we can't say that all of what's happened since then has been due to that statement, but at the very least, that statement was a straw that broke the camel's back, because since then, markets have been dropping across the board. So now we know a little bit of what was the trigger, but let's try and figure out some of the stuff underneath, because the way I like to think about it is like a bottle of soda. Kira, can you pass me that soda really quick? I actually happen to have a bottle of soda as an example. Not sponsored by Pepsi, by the way. This is the stock market. This is what happened to the stock market over the past month or so. And this was Jerome Powell's speech. Causes quite a few bubbles to form. So, in my interpretation of what's going on, Jerome Powell's speech, yes, was someone twisting the cap off and letting out that steam. But someone shook the bottle up beforehand. And I want to talk about what shook it up in a little bit more detail. So let's take a look at why the stock market reacted so poorly to Jerome Powell's statements. And as everything we're probably going to talk about with forecasting, there's not one single answer. But here are a couple of things that I pointed to give an indication as to why. First, and most largely, in my opinion, very, very strange quarter 2022 earnings. We saw an earnings season unlike one in a very long time, because what we saw were earnings reports not outside of anything we've seen in the past. They weren't extremely good, they weren't extremely bad, they were average. What was not average, though, was how the stock prices reacted to these earnings. On average, if we look at at S&P 500 companies that posted earnings under estimates saw just a 0.01% loss, so basically break even if they went under their earnings. Now we can compare this to the 5-year average that we've seen. By the way, all this data courtesy of FactSet. Thank you very much for doing some awesome sector rotation analysis surrounding earnings. But companies that were under their earnings estimates broke even, slight loss. In the 5-year average of what we've seen in the past, that loss has been 2.4%. So companies were performing almost 2.5% better if they were under earnings estimates. Now, if they beat estimates, then we saw a large shift, because we went from the 5-year average of just under 1% at 0.8% positive gain to almost 2% at 1.9% positive return following their earnings report. That is well outside of any averages or expectations that we had prior to this earnings season. So what we saw was an earnings season that bad results were not being punished and good results were being praised and held up to a very, very high value. That is interesting because it's that shaking something up. It's something we expected much worse. Investors want to feel like things are getting better, but more importantly, in this case, they were putting their money where their mouths and their feelings probably were. They want improvement. We want to see bull markets return. And this was an inciting incident for many investors to feel that we are moving towards that bull market and boosted stock market investor confidence. So that's not the only thing though. Like I said, that is the big one that we can point to, but there's some smaller ones worth talking about as well. So let's take a look at a few of those other indicators that we should mention as well. The first, and one of the biggest topics for the past few months, and will be the biggest topic moving into September, inflation. Inflation, for the first time in 2 years of almost universal increases, saw a sizable decrease, dropping from 9.1% down to 8.5% in July. The Fed has been aggressively tackling this inflation rate with monumental and 20-year high increases to their federal funds rate. By the way, the 20-year high is the size of it, not the actual percent of it, just to make sure that's clear. But they've been tackling this very aggressively to try and bring that rate of inflation down. And for the first time, we've seen that rate top out and hopefully begin a downward trend. A very positive thing for everyone, investors and consumers alike. At the same time, because this topic of inflation oftentimes causes us to think about recessions as well, we've seen that one of the main indicators that is historically true of recessions is a rise in unemployment. So far, we've seen no change, or rather little change, less than 0.2 to 0.3% per month change to unemployment, still well below the multiple percents that we could expect to see as a result of recessions. So what we're seeing is, are we entering a bull market and are we past the worst of our economic downturns? Well, these points are kind of giving us an inclination of it's very possible. And as a result, markets were trending positive. Not even just with these announcements, leading up to these announcements, markets were trending positive already. And all of these impacts combined to help bolster investor confidence, thinking that the worst of it is behind us and that we're well on our way towards bull markets. If you look at the NASDAQ, already in a bull market. The SPY, close behind. The Dow, following suit as well. And then Jerome Powell spoke, and everyone took a little bit of blow to their confidence, and the proverbial bottle cap got twisted off. Sadly, there's not much fizz left in this anymore. So, anyway, let's talk about his speech, what he said, and why it really matters. His speech was a massive change from the market-wide enthusiasm about where things are at currently. In his speech, he talked about the Fed's continued and aggressive approach to tackling the current rate of inflation. Quote, even if some pain is required. Now, that was a huge blow to investor confidence because it indicates that the Fed isn't happy with where things are at. And they don't think that the economy and the market, in turn, are self-regulating yet. They feel continued changes are going to be necessary to how they're handling monetary policy and, yes, the federal funds rate as well, and that more decisive action is going to be needed to get us back on the right path and back towards an autonomous, well-functioning, and healthy economy and market. But if all of that is a little bit too out there for you, we'll boil it down in a little bit to give you some ways of keeping track of this and figuring out why you should care. So let's just get straight into the forecast so we can talk about some numbers, put some data to all of this, and go over what we should be keeping an eye on moving through September. Really quick, let's talk about how we will actually go through this, because there is a lot for us to cover. The first and biggest thing, I'm going to try and take my opinion out of this as much as possible. Wherever I can, I'm going to give data, I'm going to give the source of the data, and a recommendation of if you should go and take a look at that data yourself. In some cases, I've done my best to summarize it into something that's usable without changing the value and the knowledge that it carries. And then in other cases, what I put together today is just meant to be an introduction, and I will very much encourage you to go and explore the data yourself to find what matters to you and to draw your own conclusion from it. So we'll be looking at a couple of different categories for today's review, or today's forecast, I guess. The first is we're going to look at key dates, different dates of the month that we should keep an eye on for both market and economy milestones. The second is going to be major market indices or indexes. We're going to look at their historical returns to see periods and probabilities of what days, or in this case, weeks, we might see indices perform better or worse. Then we'll go and take a look at sector ETFs and their probabilities of positive return, as well as we'll take a look a little bit at a resource that will allow us to look at sector performance in a much more granular way. Again, that's one of those that we're not going to have time to get it super into it today. If we do, I'll do my best to go through it, but otherwise, I'm going to encourage you to go and explore it for yourself. And then, because this is sectors made simple, I want to bring it back and talk about sector rotation. Take a look at our relative strength matrix, which is a one-stop shop for seeing what sectors are market leaders today. And we'll see who the leaders really are, who the leaders might be in the future, and evaluate them on both short-term strength and long-term trend. So, let's do it. Let's start off with key dates. These dates are going to be single days or weeks or just periods that there will be an increased amount of information becoming available to us. This information will either be the result of market movement or will influence market movement, and for any savvy investor are necessary parts to understand and to follow, as they will influence what will happen in the market in September. The first one, unfortunately, I can't really say keep an eye on it and put it on your calendar because it already happened, but I want to mention it really quick. August unemployment. I mentioned before how we have July's unemployment numbers. We're at 3.5%. Right now, we got, and by now I mean today, we got August 2022's unemployment numbers. This unemployment number showed that we did see an increase in unemployment, rising from 3.5 to 3.7%. Again, we'll take a look on the next slide about why this matters and also take a look at some data to back up what I'm going to mention. The second one is going to be September 13th. On September 13th, which is going to be a Tuesday, week after next, we will get August 2022's Consumer Price Index and subsequently the inflation numbers for the month. If the Fed is focused on inflation and is trying to target inflation as their primary goal, we should be keeping an eye on it as well. both as consumers and as investors. September 13th is when we will get a new month's worth of data and see how inflation has changed in August of 2022. The next one is a strictly market event. Being September 16th, that Friday is Triple Witching Friday. If that doesn't mean anything to you and you think, wait, this is September, not October, we're not into Halloween yet, bear with me. I'll explain what Triple Witching is, why it matters, and also we'll look at how it impacts the market. Spoiler alert, it impacts the market heavily. So we'll go and look at that in a bit. The big one that if you take nothing away from this webinar and you just listen to me explain a bunch of data that you don't care about, mark this one on your calendars, please. If Jerome Powell is shaping the market with his previous statement, this is going to be the next time that we get to hear from him. And they also give us some numbers to back up his statements. September 20th and 21st, which are the following Tuesday and Wednesday in September, we will have the FOMC's meetings for this month. And as is tradition for them at the end of every quarter, they will publish their summary of economic projections. This summary is their way of showing us where they think things are headed. It is their forecasts of where they see key economic indicators being for the end of 2022, 2023, 2024, and well into the future. We're not going to get too far into that today. I'll show you briefly the kind of information that those summaries will show, and I will be here on September 23rd to break down what happened in that FOMC meeting. So if you don't feel like dealing with the data yourself and you like how I present data, stick around, subscribe to the YouTube channel, and I'll be back on the 23rd of September to break down that FOMC meeting and the summary. So again, if there's one thing that you take away from that, put this one on your calendar. It's going to impact the market, the federal funds rate, and also the information that we have as to where key economic powerhouses think that we're headed from here. The last one is kind of uneventful, but I'm going to say it anyway because it is important for us. End of quarter three, 2022. September 30th is the end of the month, and it is also the end of the fiscal third quarter for the vast majority of companies. Not only companies, but also institutions. So we'll talk about how institutions handle the end of the quarter and what that means for us as investors in the stock market. So now let's go through all of those different dates and talk about why they actually matter. Why are we going to keep an eye on them? The first we'll start with is the one that we got today, unemployment. This is definitely one of the more indirect indicators, I'll say, but is important nonetheless. Not because it tells us bull market or bear market, but because it tells us recession or no recession, which is still a topic that's present in many, many people's minds. In this announcement, when we got unemployment numbers, this is going to help us to understand a little bit more of the severity of the economic downturn that we've seen ourselves in over the past few months and quarters. One topic that's come up a lot is the question, are we in a recession? And I've looked at that in many different ways, both through sector rotation and also economic indicators, both stocks, bonds, everything from treasury bills and on. But unemployment is the one that has been the kind of the optimist of the group. Many different indicators have indicated, yes, we are entering a recession or we are in a recession, but unemployment has been the counter argument to all of those indicators. I'll show you the data for this as well, coming from the St. Louis Fed, their data source being Fred. Thank you very much, Fred. Fred shows us that in every recession over the past 70 years, we have seen an unemployment jump of 2% or higher. Now, as the Fed continues to make aggressive adjustments to combat inflation, monitoring unemployment is incredibly important because inflation and unemployment are very, very proportional to each other. We'll see that as the Fed tries to increase the federal funds rate, that increase in federal funds rate causes money to be more expensive to borrow. Spending cuts back, large investments cut back, and businesses typically cut back on expenses, one major expense being people. So when a business starts to contract and they start to cut down spending, they're going to lay people off, increasing unemployment and continuing this dangerous cycle of businesses losing money, so they cut back on employment, which decreases consumer spending, which causes less money to go into the economy, and this self-deprecating cycle. So understanding unemployment is an important part of this cycle because it helps us to understand, are we really entering a recession, or is it just market pull, or rather economic downturn? So let's go and take a look. Let's go see what Fred has to say. What this is the unemployment rate over the past 70 years, starting back in 1948, going up now through 2022. What we see is each gray period is going to be a period that that the economy was in a recession. So we saw a recession here in the late 40s, mid 50s, late 50s, early 60s, early 70s, mid 70s, you get the point. Let's look at what happened to unemployment through each of those periods. We went from 3.8 to 6.7, 2.6 to 5.9, 4.4 to 7.4, 5.4, 6. Every single one has caused a massive swing of multiple percents of unemployment. Now, the kind of elephant in the room is 2020. 2020, we saw a massive spike in unemployment from a rate of around 3.5% prior to something in the world happening in March of 2020 to unemployment rate of, 14.7% before spiking back down. And funny enough, for anyone that's trying to say, yeah, we're in a recession, it's terrible and we're all suffering because of it, one thing that's not suffering is unemployment, where we still see unemployment sitting at 3.5% for July, with those August numbers showing a slight tick up to 3.7%. These numbers are still among the lowest percent unemployments that we've seen in the past 70 years. The only period of sustained unemployment below that was in the early 50s. Since then, 3.4 to 3.7 has been the low, and periods of recessions and what's preceded them is significantly higher. So this is an important piece of information for us, because if the Fed is continuing to make changes to to the federal funds rate, we need to keep an eye on yes, inflation, but also unemployment to see how severe the results of the Fed's movement are. If they say even if some pain is necessary, this is probably a little bit of the pain that they're talking about. So keeping an eye on this is valuable, and is why, even though it already happened today, I still want to include it in this talk when it comes to looking at what September has in store for us. Thank you for your data, Fred. All right, moving right along. Inflation. Inflation is at the center of it all right now. Inflation is the big topic for consumers and investors alike. Now, with some minor exceptions, and by that I just mean periods of flatness, inflation has been skyrocketing for the past 2 years. where in May of 2020, it was down at 0.1% to its peak in June at 9.1%. So obviously, everyone, regardless of if they are involved in the market or not, are focused on inflation and wish for inflation to drop. But again, as I mentioned before, when inflation starts to drop, it can either be by nature or by force. And by force typically requires or results in a little bit more turmoil than by nature. So it's going to be important for us to continue tracking this piece of information, especially leading up to the FOMC meeting in late September. And thankfully, 1 week before their announcement, we will get August 2022's CPI and inflation numbers on September 13th, which will give us a lot more knowledge about where inflation sits today and provide the context for which we will need when the FOMC comes out and says that they are, again, prediction, not promise or anything, that they are raising the federal funds rate by 0.5 to 0.75% again. Now, let's look at the market with triple witching week. While witches might be popular in October, in the market, witches are popular in September, and rather are popular at the end of every quarter of the year. And like September is the end of quarter 3, triple witching week will happen in September. This triple witching week refers to an event that happens that Friday, where we'll see 3 different major derivative markets all see expirations of contracts, where we'll see stock options, index futures, and index options all expiring that Friday. These expirations are going to result in a possibility of higher volatility, increased trade volume for both derivatives and their underlying assets, and overall create a little bit more chaos in the market. We see a lot more movement, and as we'll take a look at, we see a pretty large change from just normal everyday market activity during that period. And that gets a little crazier and crazier the closer to Friday market close we get. So people refer to triple witching hour being the very last hour of that Friday. But in general, that entire week is a period that keeping an eye on the market is a little bit more important. Now, in the next section of this forecast, we will take a look at some data, and we'll take a look at how different indices have responded to triple witching week in the past. But for right now, I just want to finish getting through the why they matter of these key dates to keep an eye on. And just to clarify, these September triple witching events are going to take place the week of the 12th to the 16th. Now, on to the FOMC meeting, the big one. This meeting is going to be the next time that we not only hear from Jerome Powell, good old J. Powell, but we also get to see some action from the Fed, where he'll turn his statements into actions and decisions that the Fed will make. One of the most transparent and direct changes being changes to the federal funds rate. This meeting, as I said before, is likely to result in another increase to the federal funds rate, as the central bank tries to get us closer and closer to what they want this federal funds rate to be to try and manage the economy in a proper way. The best estimate that we have right now of where they see this going is going to be from the previous summary of economic projections that we received a couple months ago. In those statements, which I think I have a copy of, and we'll take a look at those in 1 second, they quote that they see the rate being anywhere from 3.1 to 3.6% by the end of that year. Now, like I said, the data that we have for the current summary of economic projections was published on June 15th. This upcoming meeting will also provide us with another summary of economic projections, giving us more information as to where the Fed is seeing things going. But just as important as where they think things are right now is the ability to look and compare right now's forecast to June's forecast in the past and see how close were they and how much is changing. To provide a little bit more context and to give you a visual association with what that data might look like, here is the summary of economic projections, and I'm going to focus entirely here on this group. What we see here is going to be the table of all of the different members of the FOMC, of all of the different Federal Reserve branches, giving their statements of where they see change in GDP, unemployment, inflation, and the federal funds rate by the end of the year. So where do they see it? Well, the median is going to give us an average. The central tendency is going to get rid of the really high or really low guesses and give us kind of like meat and potatoes of it, whereas the range is going to show you everyone, outliers included. Right now, let's just take a look at the central tendency. Keep it looking in the middle. What we see is that we saw different Q2 results, where we saw Q2 earnings drop compared to Q1, showing us that we might be in a mild recession. But by the end of 2022, the FOMC was pretty unanimous on where they figured the number was going to be for GDP. They saw GDP ending up around plus 1.5 to plus 1.9%. But that is almost half of what their estimates were back in March, showing that they had to get a little bit more conservative based on what's happened so far in the year. Unemployment remains almost unchanged from March to June, with an unemployment rate of 3.6 to 3.8%, which is very in line with our current rate of 3.7%. That is an indication that I just went to the wrong page. There we go. That is an indication that the Fed does not see large changes in the unemployment rate occurring in the future, a potential sign that the Fed feels that changes can be made in the economy, bring us back into a positive direction without triggering a recession. We did see their estimates of inflation rise slightly, for PCE inflation being 5 to 5.3%, and core inflation being 4.2 to 4.5%. But the one I want us to focus on here is the federal funds rate, where their estimates went from 1.6 to 2.4%, with an average of 1.9, up to 3.1 to 3.6, with an average of 3.4%. That is where we should see the Fed working towards by the end of 2022. That is still short of that is still above where we are right now. We are still short of where that target is. So if we do see an increase in the federal funds rate, it is expected. This is the last time that they told us what we should expect to see, that what their projections are, and their projections indicate more changes in the future. So if we do see an increase, it's expected. The real telltale signs that we should be aware of, though, will lie in the summary of economic projections as we get to see how this number changes from their June estimates to their September ones. And then the very, very last one, Q3 ending. Yes, it's a milestone, or it's a date marker for fiscal reasons, but it's also going to be a little bit important because it is the end of Q3 for GDP. Now, we've spoken about the importance of GDP in the past and how much weight different economists and many traditional economists place on GDP for gauging recessions and other economic downturns. Now, as we move closer towards the end of the year, the end of the quarter, estimates get closer and closer to figuring out what they think the real change in GDP for that quarter will be. This number is tracked by a program called GDP Now by the Atlanta Federal Bank. So, according to their most recent publication on the 1st of September, being yesterday, the Atlanta Fed placed their estimates for quarter 3 GDP growth at positive 2.6%. That is a sign that falls in line with the summary of economic projections, and more importantly is an indication that the worst of things actually might be behind us. If we're already seeing GDP growth pulling out of its slight downturn, that's a positive sign. And that is something that we won't know in September, but is important for us to know that is coming up next. More importantly, for what we care about in September is another thing that happens towards the end of every quarter: rebalancing. It's common for institutions and other large-scale investors to reallocate investments every so often, and reallocating their investments at the end of a quarter is not a rare occurrence. We should expect to see that. So, towards the end of the month, especially on the last day of the month, expect to see some larger changes in stock prices as these different institutions are selling off and buying new securities, and this is historically led to bear market activities on that day. Speaking of bear market activities, let's go and talk about some probabilities. The data that I'm going to be sharing now comes from the Stock Trader's Almanac. This almanac provides a calendar of percentages for various major indices. But more importantly, these percentages are probabilities. They show us out of how many years, how many of those years, the percent of those years that we saw a positive change in the market for that day of the month. Now, looking at the data in the actual almanac is a very spreadsheety kind of view. It's a bunch of columns and no real analysis behind it. So instead of trying to just give you a copy of that sheet, I wanted to do something transformative and interesting with it. So I turned it into a giant heat map. Let's go and take a look at what I prepared. So I'm going to show this to you first, and then we'll break it down to show what it actually discusses. Apparently, my slide explaining what it discusses has gone poof. So we're going to do it by charades. This is the spreadsheet that we have to represent the data for the for the major market indices for September. In the left column, we have this year's day of the month, my bad. Starting on the 1st, ending on the 30th. Then we'll have two sets of columns for some of them, and then only one for the Russell, where we'll see the Dow over the past 66 years, and the percent being the number of years that we will see a increase in those indices. So in this case, if we see 56.7% for the Dow, that means historically on the first day of the month, the Dow goes up by 56.7% of the time, goes down 43.3% of the time. We can expand this across all the way, so 76.2% of the past 20 years for the Dow on the second day of the month, the Dow has gone up, so on and so forth. Any numbers above 50% means on average, it's going to go up more often than it's going to go down. So those numbers will be in green. The darker the green, the higher that percent is. The darker the red, the lower below 50% that is. S's are Saturdays and Sundays. H is going to be a holiday. In this case, the only holiday we have is the upcoming Monday. The last thing I want to show you before we get into breaking down what this data can show us is that there are a couple of lines that are bolded and italicized, being the 16th, 20th and 21st, and the 30th, representing some of those key dates that we talked about before. Triple Witching Week and the Friday that it has, the week of the FOMC meeting, which doubles as the week after Triple Witching Week, and also the very last day of the month, being the end of quarter 3, and a rebalancing period for many large institutions. I'm going to zoom this out a little bit so that we can break things down in a little bit more of a digestible way. Can we go to 120? We can. Cool. Hopefully this is good. If it's a little too small, I apologize. Now, let's just make it big. We'll just make it big and we'll work with that. Okay. Maybe a little smaller. There we go. Let's start at the top. What we see is pretty average market behavior across the entire market. On average, things perform decently well in the beginning of September. There are some days for certain indices like the Dow historically and the S&P have historically performed not great on certain days, but there's nothing to say this is a day that we should expect the market to go down or a day that we should expect the market to go up. Everything is within reason of what we could expect a normal market behavior to be. Until Triple Witching Week. Triple Witching Week, with the exception of the NASDAQ and the Russell, which see less than 40% of the time a positive return, meaning over 60% of the time, the NASDAQ and the Russell, the day before Triple Witching Week expirations, goes down. Compare that to every other index, where we see pretty sizable returns in the first 2 days of the week, being over 60%. And if we look on Triple Witching Day itself, for the past 66 years, a percent above 55%, and over 70% positive percent. Sorry, a probability of over 70% that the market goes up for these different indices on Triple Witching Day itself. Now, that's where the good news kind of ends, because whether it be due to the FOMC meeting or the week after Triple Witching Week, which historically is a bearish week, it's hard to know what's part of one and part of the other, but they're going to lump together regardless, so we're going to treat it as such. We see a period where basically everything performs poorly, with many indices seeing periods that 3/4 out of the time they return they return losses. This creates a large area of concern for investors, because this is going to probably be where we see pullback. This is going to be where we see the market contract once again. And I can expect, if the FOMC meeting is as substantial as we expect it to be, it's going to be even crazier this year. The one thing this does not show is magnitude. It doesn't show us how big the changes are. Anything from minus 0.1% to minus 100% are all shown in one data point. So this does not show us magnitude, but if I were to guess, we're going to see some very substantial changes surrounding the FOMC meeting and what comes from that. That is kind of amplified by the fact that this is the week after Triple Witching Week, which also historically is a bearish period. We then see negative performance that works its way back up to neutral, and then a sharp decay once again for large institutions and large major indices leading up to the quarter 3 end, with the last day seeing percentages for the NASDAQ being a little bit on par, for the Dow and for the S&P 500, about 55% of the time to 60% of the time, we will see losses on the final day of September. The extreme outlier here being the Russell 2000, that 66% of the time, 2/3 of the time, sees positive returns on the same day, while the Dow and S&P are flipped, almost 60% likelihood of losses. So that is a day-by-day breakdown of major events that we should expect in September and how those major events overlap with the probabilities and chances of different major indices going up or down on that period. We don't have very much time left, so I do want to keep going here and get through the rest of these points. So let's now move on to S&P 500 sector probabilities. Unfortunately, Stock Trader's Almanac doesn't give us that data, so I had to do my best to make it myself. So the table we'll look at next is using data from stock charts, where we'll take a look at different sector ETFs for the S&P 500 and the S&P 500 ETF SPY itself. For each of those ETFs, we'll show the percent of years, the probability, once again, but in this case, instead of 20 and 66 years, we're going to do 5 and 10 years, that ETF had positive returns, and I'll also show you the magnitude of those returns during September. As I said, all of this data was sourced from Stock Charts' seasonality tables, and this is going to be the one that I encourage you to go and explore yourself. I cannot show you all of the detail that there is because it is very granular and it does require you to have a goal in mind when you go in to explore it. What ETF are you interested in? Where are you curious to see? Oh, hi Mom, welcome. I'm glad you could make it, and I hope Alaska is beautiful and hopefully not too rainy. All right, let's go and take a look at this. I want to go through it a little bit quickly because there's not too much to show here, but I want to get to the summary as well. What we see is September on the whole is not a great period. We see that energy is the only sector ETF that breaks even throughout September, with the majority of sectors having a higher likelihood of returning negative results in the month, with only 2 being positive above 50%. Then lastly, over the last 10 years, we see a much more mixed bag of probabilities, but the magnitudes show a different story, with the majority of sectors still returning negative results in September. So what does that actually show us? That when we look just at the 1-month changes in sector ETFs, there's not much positive for us to look at. Now, that shouldn't be a surprise, but really every sector either saw no positive change or negative changes in price. But again, it's super important that we put that data into context and that we realize that the 1-month story doesn't show it all. Because when it comes down to it, let me try and get that table back. This is by the end of the month. But as we've seen, the month is not a straightforward experience. There is a period of surge and then pullback, working up towards the middle of the month and then down towards the end of the month. And in that, we don't invest month by month. We invest day by day, or for day traders, even shorter. They might invest minute by minute. But it's important for us to know where those periods of offensiveness and defensiveness really come in. And that's what I want you to be able to take away from this. It's not every sector ETF loses money in that quarter or in this month. There is a ebb and a flow that we need to be aware of because it will help influence our strategies for how we invest, whether how aggressive or defensive we choose to be during that period. And again, there's no better way to experience this data than to go and do it for yourself. On Stock Charts, under Charts and Tools, you can go to seasonality and you can see this, but if you go down here, you can also break it out to see the actual percent changes throughout the year so that you can see September and see how the different returns have been in the past few months, or sorry, the past few years for September. Not just did it go up or down, yes or no, and how much. Now, let's get into sector rotation before we end today's webinar. Sector rotation has undergone some significant changes over the past month and sits in a very interesting place of limbo, waiting to see what happens next. We saw some sensitive sectors, such as discretionary and technology, get hit hard, with discretionary down almost 8% over the past 2 weeks alone. And in their places, to ascend to sector leadership, we've seen many defensive sectors, such as healthcare and staples and utilities, make a resurgence. So our current sector leadership is made up of those defensive sectors, but discretionary and technology, as well as energy, aren't out of the mix. They are still thrown into the top half of the matrix and are in a position that we question who could be the leader next. Because if what we are seeing right now is pullback, it makes sense that defensive sectors are performing well. But if we see the market make a recovery, and in the first half of the month we see this positive momentum return, we might see those more sensitive sectors like discretionary and technology make a comeback once again. So with that said, here is the current matrix for where things sit today on September 2nd. Utilities is our overall leader, with staples in second, tied with energy. Then we have healthcare and discretionary tied for fourth, I guess it would be. If you've never seen the matrix, welcome to the matrix. This is our today's snapshot of what sector rotation looks like. X count shows short-term strength, positive trend shows long-term strength. So it allows us to look to see what sectors are holding a lot of short-term strength, what sectors are holding a lot of long-term strength, and what sectors might just be strong overall. What I'm seeing here is a lot of sectors that are very imbalanced with their weights. Energy, technology, SPY. There's many sectors that have massive imbalances between short-term and long-term strength, and a good week in the market might be enough to see some pretty sizable shifts in this relative strength. If you're interested to see more of the matrix and see how we can use it to track sector rotation, please head over to our website at sectorsmadesimple.com, make a free account, and sign up for our newsletter. Every Monday, we send a list of sector rotation insights straight to your inbox, completely for free, and that's it. So if you're interested in seeing more about this and hearing more insights about sector rotation, head over, make a free account, and join us there. Now, before we end, I've talked a lot, and for some of you, this might have been a lot of information. But let's boil it down. Why should I care? Well, you should care because September has historically not been straightforward. There is a period of a lot of growth in the beginning of the month and pullback towards the end of the month. And due to a combination of options expirations, Q3 ending, and economic metrics, this September especially is going to be important to follow. Investors are being aware of what's going on, and we need to be aware of what's going on to help us understand more of the macroeconomic things, a lot of the, not just involving the market, but the high-level things as well that are going on that influence the stock prices that we all are exposed to through the stock market. So with today's information, I hope that you have a more well-rounded knowledge of September. You understand periods that we can look to be a little bit more aggressive and periods that we should expect to see more pullback in the market to help influence our decisions, whether it be on a day-by-day basis, week-by-week basis, or month-by-month basis. So, that's all I have for you all today. Thank you so much for joining us. If you found today's information useful, again, hit the like and subscribe buttons down below. They're completely free and they do a lot to help us provide more content like this to you all. And again, these webinars we do live every Friday on our YouTube channel at 4 p.m. Pacific, 7 p.m. Eastern Time. So if you want to join us next week, feel free to pop in and say hi. We'd love to see you there. If you have any questions for me or have topics that you want to hear me cover in a future webinar, please send us an email at support@sectorsmadesimple.com. We don't have a support team. I am the support team and my wife is the support team. So sending an email to that is your way of getting directly in contact with us to find how we can help you make investing simpler. So thank you all so much for joining us today. Have a great 3-day weekend and we'll see you all back next week. Take care, everyone.